what China is doing and has been doing, to just step back and unpack it, is accumulating more gold in its reserves while it is selling US Treasury bonds. Why? Because it rightly understands that investing in US debt is not as valuable as investing in a physical, real asset that can be an underlying asset for global economic and financial commerce. So it understands this, and it has for a while. And plus, it has the processing capabilities, the partnerships, and the availability of physical gold. And it's very important that what China is doing is, and what it's letting its retailers and its banking system do, is follow the flow of physical gold. In other words, purchase physical gold. And that's one of the reasons that we have seen, it's not the only one, it's many reasons that we have seen gold outperform, for example, gold miners in the last few years, because there is much more buying, particularly of the East, and particularly led by China and its trading partners, including Russia, including India, for physical gold. So what it's doing, there's actually two things that China is doing. One is it's trying to reposition actually Hong Kong as the main financial hub, Hong Kong and Shanghai, but basically use that sort of duality of exchanges to reposition global finance, period. Right, so this isn't even necessarily just about gold. Gold was the physical gamut to get China basically to have an independent or geopolitically neutral independent asset that it can use instead of simply just fiat currencies or simply just being involved in the dollar. It has diversified its trade from dollar, it's diversifying its trading partnerships from dollar, and it's increasing its reserves in gold. So when we look at what's happening on these two exchanges and these two localities, is that Eastern investors, Eastern nations, Eastern trading partners are increasing their volume of trade and transactions in China and in Hong Kong. Of course, Hong Kong wasn't a part now, it is a part, but basically in those two constructs, Europe is somewhere in between, and the rest of the West, the US, Canada, and so forth, is sort of behind in terms of investing in both physical gold and also diversifying its investments between East and West. And part of that's geopolitical, part of that's behavior, there's a lot of reasons. China wants to have that business, and it's actively trying to do that. The second part of what it's trying to do beyond the exchanges and creating those poles is that it's creating digital payment system. It has a system called the SIPS system. We've talked about it. It's a process, but basically to take away settlement of global transactions, which are currently in dollars and in fiat dollars in particular, because that's what they are, and to enable more banks, more countries to instead settle transactions on this prototype system. And as that continues more and more, then they take the real step into global trade, global finance, global banking, and gold is this underlying independent factor to enable China to do all of that in a very long-term strategic manner. We're going to have right now, we're almost at 37 trillion on the US. It's a mega huge number. It's going to be 40 at least before this Trump administration is done with its time. That's just the reality of the trajectory. No matter how much comes in, no matter how much of the budget's cut or not cut, taxes, that's where it's going to be. If we have this conversation, 3 years, that's where it's going to be, if not higher. So that's the reality. It's massive. And what that means is before the White House wakes up in the morning to pay its interest rate bills, it's forking out nearly $1 trillion a year. Why? Because of the massive debt, and also because rates have been quite high, and they haven't gone lower for the long end of the curve, which is where most of that debt is that finances long-term U.S. behavior. When they look at budgets, all this, sort of back and forth squabbling within Congress about budgets, they're 10-year budgets, basically. I mean, they're 1-year budgets, but they look at 10-year forecasts. Most of the debt that the U.S. holds for its own budget, therefore, is actually 10-year or longer debt. The 10-year is hanging out at 445, 450, whatever. 30 years gone over 5. That's not historically massive. Both of those have certainly been higher in our history, but not when debt was as high. And so the relationship of the amount of debt that we've had when rates were higher in our past to the amount of debt that we have now when rates are higher than they've been in 20 years, but still lower than like in the 70s, means that the cost of running our country before any of the running happens is massive. The cost of servicing debt is higher than the deficit was 10 years ago. I mean, it is massive. It is a problem. It disables the U.S. from competitively thinking about growth and development and strategy. And yes, these things are happening around the edges. We just saw the Trump administration come out with an EO on Nuclear Regulatory Commission, ease to allow more permits and less time for our producers to actually make stuff and process stuff in the United States. Things are happening that need to happen. But in general, the amount of money that the United States can pay for its own development, its own economic strategies, is strapped by waking up to this much debt and this many interest payments per year. And that's something that's not actually being discussed. What's being discussed is how massive it is, and it is. But the reality is that the downside of the debt, besides the debt, is that the competitive growth that we could have as a country is hampered. I mean, think of our credit card, and credit card debt's at historical highs as well. All these things are historical. Anyone who has to pay their credit card off first each month to keep it going, and it's at its top, and credit cards at 29% or whatever they are. But the point is, and you're paying a very high interest rate for it, you can't use it to buy anything new, even if you wanted to, and even if that new thing was useful to you, because you're just paying interest. That's the entire nation. July 1st has been batted about, again, headlined all over the place, as all of a sudden, gold's going to be considered not just tier one, which it has been, but also as something called an HLQA, a high liquid quality asset that can basically can be used for liquidity purposes for banks to say, well, if we have this much amount of gold, it actually reduces our requirement for this much amount of liquidity. Let me unpack that, because first of all, July 1st isn't a magic date, much as we would love to believe it is. And actually, the LKMA, the group in London that basically regulates the quality of gold, came out with a statement a couple of weeks ago. They sort of broke it down. There's a lot of pieces to Basel III, which is a component, the third derivation of Basel I and II, which were created initially back in '88 to regulate the global financial system, and have had lots of iterations. Here's why July 1st actually was a date. 2 years ago, when there was discussion about all of the ramifications of Basel III, it's not just about gold, it's about all sorts of regulations. The Fed came out and said, we are going to take a look at these. We are going to decide whether, as the regulator for U.S. banks, we will adopt them, and we will get back to you by July 1st, 2025. And then a year ago, about June 2024, one of the governors of the Fed wafted back and said, well, maybe it might be a bit longer than that. We're not really sure. So what was a secure date from the U.S. standpoint, from the Fed standpoint, to allow for the acceptance of gold as a high liquid quality asset is now in flux. It's 1,000% unlikely that it will actually come on July 1st, 2025, unless major things happen with the actual figures at the Fed. But here's what it is. The language of Basel III allows jurisdictions and regulators to accept gold as that form of an asset already. The language in Basel III already allows for that as of January 1st, 2025. So far, no jurisdictions, no nations, regulators have accepted that fully. What they have accepted is that gold is a tier one asset. What does that mean? What's the difference between tier one and tier one high liquid quality asset? The difference is banks have to keep a certain amount of capital. It's called capital adequacy barriers, as per Basel, on their books in case something happens over the long term. So what that means is banks have to weight the risk of all of the assets they hold. Gold has zero risk to a bank. So any bank currently right now under the current rules of Basel, if they hold gold, don't have to set aside other liquid assets or anything else or cash to back it. It's already considered 0%. So when they do their risk weighting math, it's a complicated thing. Gold is zero. That means it's good. But there's something called a liquidity ratio. That's different per banking system. What a liquidity ratio says is that if the bank has a crisis tomorrow, immediately, does it have enough liquid assets on hand to navigate that crisis? U.S. regulators, the Fed, etc., have not allowed for gold to be that role for that liquidity crisis tomorrow purpose. There are nations such as Switzerland, Singapore, Dubai that are very close and pretty much have rules that allow for gold to act in this role for liquidity and capital adequacy. So far, the U.S. hasn't. The July 1st date came up because of that. But July 1st is still important. And the reason it's still important is because A, it's out there. B, it's kind of a stake in the ground that other nations are very much looking at after having passed the January 1st date on some other rules that came into effect under Basel III, in order for them to take a serious look at actually adopting gold as a liquidity ratio asset. So the date matters, but the attribution to the date that's out there is mostly inaccurate. Well, so the Fed's holding 6.8 or so trillion dollars worth of a mixture of treasuries and mortgage securities, which are based on treasuries, out of $37 trillion worth of. Yes, but if the Fed were to actually step in and buy that, then I believe they will turn to QE anyway. I do believe they have to, to your point. But to make a real dent at this point, given the size of the debt, given how long the Fed hasn't, been doing QE, and given the fact that, rates are where they are and the payments are so high, it's really difficult. It is why they'll probably continue to cut rates more than they forecast this year to try to get some at least short-term funding down. I believe they're going to turn to QE. They're just waiting for that really bad QDP print. But that's going to, at this point, the best QE can do is save banking system failures that can come out of this high debt, as opposed to the country, which is bad enough on its own. And going back to China and these polarities in the East, that's why they're not buying our debt and buying gold. And that's not going to stop.